I always try to think about the people who are listening than myself, and what they're looking for.
Yeah.
Which is clarity, kind of come from, I think about education and just trying to think about the details and understanding what we're trying to tell them. Because, if you've been doing something for a really long time, we'll just be quick to like spout out an answer.
Right.
But it makes sense to you and I because you've been doing it for 20 years. But I forget, well, wait a minute, this is their first time buying a house. They're 24 years old. I need to slow down. I need to explain better. So
Welcome to Location Community, the podcast where real estate isn't just about finding the right house. It's about discovering the perfect place to call home. I'm Mike Rohr with Jeremy Daring of Daring & Co. Real Estate in Elm Grove. On this show, we explore the dynamic relationship between where you live and how you live, diving into the importance of not just the location, but the community that comes with it. All right, welcome to the next episode of Location Community. Mike Rohr with
Jeremy Daring.
So we have some different studio today.
We do.
We're
different scenery.
We're moving up.
We're trying different things.
We for sure are.
Yeah.
So I mean, for people who are joining in and have seen the prior episodes, please let us know your thoughts. With the prior studio and with this one here today. So, again, like Jeremy said, thought we would change it up. And, again, thanks for joining us today. And, like we've asked in the past, please subscribe, tell your friends, share the podcast and leave us your feedback. Always looking for ways that we can improve and want to know what your thoughts are and topics that maybe you'd find interested and insightful for your real estate needs and things going on in the community. So Jeremy, what's new? It's fall in Wisconsin.
Fall in Wisconsin. The Oktoberfest beers are out.
Yep.
There's a wide variety of flavor out there.
Okay, so what's your favorite? I'm going to put you on the spot.
What's my favorite? Just give me a lager.
So this just tried and true, right?
Yeah, just give me, sometimes I can go down and do a Dunkin' or a Dunkel,
okay.
I think it's called. But I just give me a nice golden Pilsner lager right now. Yeah.
So when you go to Donahue's, they have all those taps. You're not trying anything different?
No, I found that the IPAs tend to give me a little stuffy and some headaches. They're good. But other than that, I just try to stick with the lagers right now.
Yeah, no, same for me. I like them the night of, the next day, not so much.
That's right.
Not so much.
Other than that, we're kicking off the kids' sports, so that's in full effect.
Yep.
We got NFL, college football, which is exciting. I'm a big fan of that. So yeah, I love where we're at going into fall. As you know, the real estate is starting to slow down.
Yeah.
And it normally does after the Labor Day weekend. And there's a period for the next probably 2 more months where we see a lot of activity going on before the snow actually flies and drops. But once the snow hits the ground, things tend to slow down.
Yeah, come to a little bit of a halt.
Yeah,
for sure. Yeah, so I mean, and last time, on the last episode, we talked a little bit about just the market balancing out, right? Where houses haven't been or aren't on the market quite as long. Interest rates are slowly ticking down. I think we talked last time that, rates are, looking to maybe be in possibly the low 6s here as we finish up the year. And then, kind of sustain that and maybe go down a little bit more as we go through 2025. Houses are staying on the market a little bit longer. Like I said, and it's kind of impacted the market balance, so to speak. So not as much of a seller's market, but still, kind of getting that neutral area, but still a seller's market, but not as strong as maybe it has in the past. The number of offers for houses are, coming down a little bit, right? There's not as many offers, so buyers are able to go in and have a little bit more contingencies, right? As far as the appraisal contingency, the inspection contingency. I mean, heck, a year ago, right? I mean, there's so many houses that were bought and sold without the contingency, without inspections, correct? So all that's kind of starting to kind of even out a little bit, which is a good thing for the buyer. And then we also talked about price, right? Price is such a big factor in being accurate and realistic on the price of homes. Because if it's not dialed in, if it's not like the top house within that price range, they're sitting
there.
And then having to take that price reduction or even go have the listing expire and then come back in at a new price, right? If you get the price right to begin with, you're going to be better off and probably going to get more from your house than kind of going through that whole process.
Right. Instead of that house sitting and continuously being, viewed as a house that's what's wrong with it, then no one wants it, right?
Correct.
And it's that little gray cloud over the house.
Yeah.
And then at that time, people are then more compelled to put in lower priced offers or low ball offers.
Correct.
At that point.
And that's why it's important even for the seller, right? Like, what are their expectations? Being able to manage those expectations. Do they want to get out right away? Do they want to go through that whole process of showing the house, having it expire, bringing it back up, and then price reduction, and then maybe not getting it as selling for as much as they would have if they would have just listed it at the right price.
Yeah, correct.
To begin with.
Yeah, and that's, in some cases, especially the higher priced homes, we would like to see what kind of activity you get at a certain price range, and then you pivot from there to, maybe doing a price reduction. But I am seeing multiple price reductions, stemming from, the $200,000 price range up to the $1 million price range.
Yeah.
And some of them, in excess of over $100,000 of a price difference.
Correct.
Yeah. So yeah, it's as what you'd said, Mike. I mean, it's starting to mellow out, right? It's starting to kind of plateau where people have been impacted by the higher price interest rates and the higher monthly payments and the cost of inflation with building and material and tradespeople and all. I think all that is coming to, fruition with, what's happening with the economy and
for sure,
what people can afford.
And I think and then also we discussed in the last episode just that a lot of people think that, and I think there could be some debate there, right? Our prices, how much are they going to come down? Is there going to be appreciation of houses in general? But I think all the data still shows that you're still looking as we go into 2025, as interest rates do come down, you're not going to see the double-digit appreciation of houses, but you're still going to see back kind of to normal, right? Maybe 2-3%. So if people are looking to buy, waiting for that right time, I mean, there's so many variables that go into that. And if you're at the place where you're looking to be like, okay, I'm going to come back into the market, I'm going to start looking again, I think it kind of goes down to then just maybe a review today on like shopping mortgages, like things that they need to be aware of as they come back in, getting pre-approved, things like that.
Yeah, absolutely. The first step in determining your buying power, and then your overall ability to buy a house. And then, that's the first step, right? Is meeting with a qualified mortgage lender, mortgage banker. There's various names for people in that industry. So someone in the industry that can provide a mortgage, that's, by far your first step in determining. And in that case, a lot of the mortgage lenders and the guests that we have does a really good job in laying out and looking at the whole big picture for someone, right? Looking at what their debt obligations are, looking at their student loans, if they're going to come due, and really talking to that person, almost kind of like a financial advisor, right? Because, hey, you have to consider you have electric, you have water payments, right? You got
upkeep on the house.
Upkeep, you got to furnish it.
Yeah.
So do you have the reserves in order to do that? Do you have enough reserves to buy a furnace if the furnace, takes a, goes bad?
Yep.
So yeah, those are the first step is definitely working with that mortgage banker.
Yeah. And I think it's then important as well. Like, okay, you can get pre-approved and you can be approved for X amount, but are you comfortable with that? Right? Just because you're approved for something, what is your comfort level going into buying a house?
That's right.
And then as you see the houses, am I willing to pay extra, go above that budget? Those are conversations that are important from a real estate with their client as well as the lender that they're working with.
Hand in hand.
Yeah.
Yep. And I feel like more people, especially millennials, Gen Zs, these conversations I'm having with these younger generations are getting more educated. I mean, they have a lot more questions. Yeah. They're looking at things a lot more clear. I believe social media has been a huge help to that.
Yeah, we hope so. That's why we're here in the podcast. So,
well, everything's on the palm of your hand.
Yes.
So from the Instagram to Facebook, but absolutely. I mean, that's why we're here is providing, relevant content.
Yeah, and the avenues that people are going to.
Yeah.
Right.
And it's just, I had a great conversation with a millennial, real at the tail end. He's actually a Gen Z. I said he's a Gen Z, and he said, no, I'm a millennial.
Not yet.
And he had not yet.
Or not ever, right? I guess it's not yet, not ever.
But we walked out of that meeting. He wants to buy a house this winter, and we walked out of that meeting, and he says, I think I need to put save more money. I think I need to have some more money before I buy a house. And in consideration of his job, in consideration where he's at with his girlfriend, getting married, multiple things that come into buying a house, and especially now with the market the way it is.
Yeah.
There's just many things to decide or figure out. And no one has a crystal ball to do it, right?
No.
And you got to, buying real estate, you just got to jump. I mean, you got to jump in and do it.
If you're ready, there's not going to be a perfect time.
Yep.
Right. You just got to be able to go in and do it.
Yeah. Yeah.
So, I mean, over the past year, 2 years, I mean, there's at least, I think you've shared with me in some of our conversations that maybe a lot of people have been doing ARMs, right? Mm-hmm. From a loan standpoint. I mean, there's so many different options, right? You can do ARMs, you can do fixed, 30-year fixed. There's FHA loans, there's VA loans, there's all these different options.
USDA.
Yep.
Yeah.
That come into it. So as well, I think a lot of people sometimes don't realize the different options that they even have.
That's right.
And especially as interest rates coming back down now as well, even if you jump in and they do go down more, you have that ability to refinance.
Yes.
So I think it's, again, there's no perfect time. Only when you're ready and say, hey, I'm ready to do this. I can, get pre-approved and go into this process. And I feel comfortable that at this amount, I'm going to make the jump to purchase my first home or my second home or sell and upgrade to a bigger home, whatever the case may be for our clients and the customers. Mm-hmm. So today, I mean, I think we talked based on what's happening with interest rates, and we thought it would be valuable, and we've always talked about just the best part of this podcast is bringing business owners, community leaders, municipal leaders, et cetera, and this also other people that we work with to kind of bring some good relevant information that are in the community. And today we have a great guest that, if you want to, I know you've worked a lot with him, if you want to give an introduction to our guest.
Yeah, I've worked with this guest for since 2004. We've worked together.
That's awesome.
So we've Josh Busil from Waterstone Mortgage, good friend and just a great companion to have in the business and to share great ideas and to really provide good service to our clients. And that's what you've done an exceptional job with. So yeah, thank you for coming to this podcast. Appreciate that.
Yeah.
Thanks for having me.
Yeah.
So you've said you've been on a few podcasts, right? You're probably more of a pro on this than.
I was counting on the way here. I think 3,
Okay.
actually. So
Okay, we get
my
you beat.
pro level
I think
yet?
this is 5 for us. So
I feel like I'm not rookie anymore, whatever's in between there.
Yeah.
So yeah.
You seem like a natural.
Do I?
Yeah.
Okay. Well, I
Yep.
appreciate that.
Yeah.
Yeah. I always try to think about the people who are listening than myself, and what they're looking for,
yeah,
which is clarity, kind of come from, I think about education and just trying to think about the details and understanding what we're trying to tell them. Because, if you've been doing something for a really long time, we'll just be quick to like spout out an answer.
Right.
But it makes sense to you and I because you've been doing it for 20 years. But I forget, well, wait a minute, this is their first time buying a house. They're 24 years old. I need to slow down. I need to explain better. So anyway,
Yeah.
I think about that.
So true.
Yeah.
Yeah.
ask more questions,
Yeah.
right?
Yeah.
Get to know them.
Ask the
and-
questions they don't even think to ask, right? Because buying a home is one of the scariest and exciting things someone does in their life.
for sure. A lot of mixed emotions.
Yep.
Yeah. And I think just with everything that has happened in the last 4 years, right? 4 to 5 years, it's even scarier.
Yes. Yes.
Just with
But just the
prices of homes.
Yeah, like okay, I'm going to buy a starter home.
Mm-hmm.
This is more than I thought a starter home was going to be.
So true.
Yeah.
Right?
Yeah. I call it affordability, right?
Yeah,
What does affordability mean to one person to the next can be a little bit different.
for sure.
But payment, right? I always talk because I'm as a lender, right? I am thinking about affordability for the people, and affordability usually means payment, and that doesn't mean just the loan payment. It's the property taxes, the homeowner's insurance, you guys are talking about maintenance or upkeep, and then everything else that's gone up, the whole inflation with everything, right?
Gas,
You know,
electric.
So just add all that in there. If something has gone up hundreds of dollars, does that affect a family's affordability?
Yeah.
Sometimes not.
Do you get into lifestyle at all? Do you
Yes.
ask them?
We talk about that a lot, actually.
Mhm.
So some people will say, Josh, you're pre-approving me, but I feel like that's too high. Because some people come to me and they say, what's my max? What's the most I can qualify for? And I'll give them that number, but I'd say 9 out of 10 times it's way more than they can afford, right? I'm not a financial advisor, but I have enough experience to kind of walk that path with them. And then I will say, you can go up to 500,000. And they're like, whoa. And I'll say the payments. And they're like, whoa, that's way more than I ever thought I'd
Yeah.
spend. And I said, okay. Then I'll ask, well, where do you feel comfortable, right? Where do you think is affordable for you? And then as we get into that, they will say a number. Let's say it's $3,000 a month. And then I'll say, will that allow you to live the lifestyle that you're used to?
Mhm.
Right. And everyone's lifestyle is different, right? Some people are homebodies and they love to like have people over every weekend and family and whatnot. And some people don't like to be home much and they like to travel and they go out to eat and they buy nice, fancy things. So different walks of life will determine that decision on the house, I think, or at least the size of the house too. So many times I have that conversation and the reality kind of kicks in. I feel like they get googly eyes when they're on the Realtor.com app or they're on your MLS searches, and then they come to me, and then reality kind of sinks in. Like, ooh, it's a little more than I wanted, or maybe the reverse. I can actually afford more because sometimes people have big down payments. So, like for example, I see a lot of people now are move-up buyers, right?
Yeah.
So the last 4 to 5 years, the equity has gone up so much.
Yeah.
So they're transferring that equity to the next place, not realizing that's helping the affordability quite a bit.
Yeah.
So they can afford that $600,000-$700,000 house when they never thought they could,
Yeah.
because
That's
you're not
true.
financing that much, right? You're
Right.
financing way less.
And I mean, so I think I saw a stat where people have been in a house for 5 years on average have like they've gained like 50% equity in what they initially put into it.
In some communities that are hot, yeah,
Higher.
they're
Yeah, can be lower, but on
Mhm.
average 50%, that's to your point,
right,
right? In 4 or 5 years, what's happened, a lot of people do have some equity
right.
that make that a little bit easier.
In some scenarios, I've seen that help offset the increase in the interest rates that everybody is seeing because the payment's gone up so much. Well, if you pile on all this equity or bigger down payment, it's helping offset that payment somewhat, not completely, but
Yeah. Make it easier.
exactly right. So the more equity you have to put towards it, the better that affordability conversation feels, right? So, yeah.
So I think a big thing that we want to focus on and try to focus on as we've got this podcast going is just the importance of community. Like where you live matters sometimes more than the size of the house. Is that ever like as a conversation like, okay, I want to have X, but I'm willing to have a smaller house because I want to be in this community. I want to be in Elm Grove or Brookfield or Tosa or whatever the case is. Is that something that you've had conversations or people have shared with you, kind of confirming things that, that what we've seen and what we've heard in what we do?
Sometimes, yeah. So schools, if there's children, schools seem to be the top topic. And where the school is the community they pick. So, and I have a child, I have a daughter who's younger. So I usually bring up, life topics of like what it's like having children and what it's like having a 7-year-old, right? Too. So if people can relate to that, if they have a child around that age. So the community is chosen, at least what I see a lot of times, because of the school and the children. Everyone's flavor is different, right? So definitely whatever anybody wants to do. But I'll get questions like, what do you think of this community or that community or this school and that school? And honestly, I don't do a lot of deep research. I'll definitely pass the baton back to you guys and say, these are the experts when it comes to community, deep diving into communities and what you need to know. But I'll give my opinion on, and whatever they're asking for. Sometimes they're asking for, what are the restaurants like? Or, I like to fish. So they're like, how are the lakes? How's the fishing over there? So they'll, we'll get into those conversations.
Yeah.
Sometimes. Yeah.
Yeah. Cause I think, that's such a big component. And there was a stat, I don't remember what it was, but we talked earlier on in an earlier podcast that people are willing to give up. Like if it has good schools, if it has the community that they want, they're willing, and let's say it's $400,000. They're willing to get a smaller house for that $400,000 because the community matters sometimes more than the house that, how big the house is. Yes. And some of the amenities that the house has, because it's the amenities and the things that the community offers when they leave the house is sometimes usually more important.
So I'm glad you brought that up. I can give where I see that conversation a lot is I help a lot of people with divorces. And in the divorce situation, the person staying in the home that needs to qualify and stay in the home, perhaps refinance, their number one goal usually is to stay there because they don't want to disrupt the child's school system.
Yeah.
So
an environment in that community.
Correct.
Right?
Yeah.
Friends. Because little Johnny knows Jack down the street and can take his bike there and, has all that safe ways that he can go outside the house and play.
That's a good word, safe.
Yeah.
They feel safe there because of the connections and the relationships they have.
Right.
Yeah.
Yeah. So I see that is like a prime motivator for the decisions these people make. And not just divorces, but that just seems to be a big one when I help people.
It really gets magnified in that situation.
Big time.
Yeah.
Yeah.
So as, we talked a little bit about pre-approval. Like I don't know if you could just walk through just, with, you're like as a lender, what do you think is most important? I mean, is it the pre-approval? Is it how is that process? Maybe walk us through that process for people listening in, or maybe first-time home buyers.
Yeah.
Well, and specify, majority of the time a pre-approval is W-2s, paycheck stubs, but what are we looking for? If you're working with a real estate agent, and what would a seller prefer instead of just a pre-approval? And that would be more of a complete underwritten, document, right?
Right.
So explain to, I guess, our audience here, the pre-approval versus maybe another document that would be more satisfying to a seller.
Yeah. In my perfect world, I wish everyone would get pre-approved before they start peeking at houses. But unfortunately, the motivation first is let's look at houses before, because so many people think, or even they know they'll qualify, but they don't think it's important. at
Yeah.
first, but
Well, they also have that stigma, sorry to interrupt, but that stigma that if they run their credit score will go down,
Yes.
right? And that's not necessarily true.
yep. So I'll touch on that in a
Okay.
second. So the pre-approval process, and I want to dumb it down a little bit for the first-time home buyer. When we, what we want to do is make sure they understand how much they qualify for, and we get into affordability back to let's match your lifestyle, because even though you're qualifying up to 400,000, you asked me for X payment. It's probably going to put you at a 300, 325 house, right? Or however that conversation. So that's how it ebbs and flows. Now, when there's two different things that you hear. You'll hear pre-qualification and pre-approval. The main difference is pre-qualification is usually verbal information. Oh, you work at the hospital and you make about 70,000 a year. Oh, okay, that's good enough. Now I kind of have an idea what you do. And that pre-qualification is not as reliable and not as valuable as a pre-approval. So a pre-approval verifies everything, okay? And there's levels to the pre-approval where the local team can do it, do automations, do visual verifications of the documents, which is their income, their debts, their assets, their credit, and their employment history. They're usually the big five that lenders do. So the pre-approval is done, and then there's also the fully underwritten pre-approvals that you're talking about, Jeremy. And that is where the underwriter does all the verification as well up front without a property, which is okay. But then that sets everything up where the quality of the pre-approval is better. Everything's been verified by local team and underwriter. Underwriter is the actual person who accepts or denies the loan.
Yeah.
The lender, the loan originator, myself, I'm here to make a really good judgment call on if you qualify with the underwriting guidelines. So I'm supposed to be very well versed in it and understand it very well, but an underwriter holds a different license to help people understand this. They actually have to make the decision. It's not my decision. So I have to do a lot of good homework up front to make sure the real estate agent feels comfortable about it and the buyer feels comfortable about it. Eliminate all the red flags, right? And there's some things that can happen. People change jobs in the interim. They go finance a car that I wasn't worried about. So those things like change as we ebb and flow sometimes. But I tell the clients to keep me in the loop if there's any major life changes like that. So the pre-approval is, I think, is the best thing. So then that can be presented to the seller as you are, your offer looks stronger, right? So if you're in a competitive situation, I see time and time again, people win with pre-approvals, especially upfront underwritten pre-approvals.
Local help as well.
Correct. Yeah,
Yeah.
local. Thank
Yep.
you. Yeah. I know you guys think about that more than sometimes I do, but the versus a pre-qualification. So credit, you mentioned about credit. There are soft inquiries done now by most lenders. I don't want to speak for everybody, but most lenders are doing soft quals so it doesn't affect credit scores.
Okay.
That removes fear, hopefully, from most buyers that have the credit inquiry fear.
It's always
It always is.
Yeah.
But I'll give you my inside from understanding credit. Let's say you have a 780 credit score or something really good.
And what is 780 is good.
780 is
excellent.
good. Yeah, thank you. So somebody who doesn't understand credit, you want to be, a goal is usually right now 750 or better. Under 750 is still okay, but it starts to affect the scores. I'm sorry, the interest rates and the closing costs. So it gets a little more expensive. Below 700, it could affect approval as you get into like the low 600s. So it's a big range, but that's where people want to focus, is in that middle 700s or upper.
Yeah.
When you have an inquiry done, the credit score is reduced on average 1 or 2 points. So if you have a 780 score and it goes down to a 778, it's going to affect nothing in most situations. Where people should be conscious of is that they're at the 701 and it drops to 699. That could be the difference between major rate differences and or approval and denial. So I see where they're worried about that. But most do soft holds on the credit report to qualify people.
Mhm.
So if somebody would go down to 699, what kind of, let's say that happens, that scenario, how long does it take, or are there things that they can do, though, to get it back up in a short period of time?
I hate to say it depends, but it does, because credit scores have so many factors.
No black and white answer.
Well, here's the most common resolution to that is debt load. So when someone runs up a credit card and they use more than 30% of the limit, scores start to go down.
Yeah. And that would be a good session podcast for someone that does credit restoration.
Yeah. Good point.
But that is the quickest solution if you have a debt load. And there's so many people, like I see a lot of people who travel and are in the business world where they're running at their Amex because they want flights and dinners and golf and whatever they
want the rewards.
Yeah, and they do. So they'll run up $1,000, a couple thousand in a month. It's real easy for some people. And then all of a sudden their scores go down because they use it, but then they pay it off. So in their mind, they're like, I'm doing the right thing. I'm not paying interest. I'm getting no penalties here. But your credit score is now ebbing and flowing because it depends on what your limit is, how close you're getting to that limit. So a solution is don't use as much or increase the limit, or just be conscious of it when you're about to apply for a loan and buy a house. After that, then, it's not as relevant. So,
in today's industry, we're talking a lot about interest rates, right? And so, that's a huge factor in the payment and what that does to impact the payment either up or down. And so we're starting to see a decline of interest rates right now. Is that correct?
Yes.
And just if you could just guide us on kind of where they were, where they're at now, and how much of a difference in payment that is for people out there. And, just getting into the kind of the facts of that. And where do you see them headed?
Interest rates peaked around late last year. Any given day, we saw quotes in the 8s. 8.1, 8.3, something like that. That put payments much higher compared to people who are comparing it to the 3% interest rates that they have. It's a major difference. Okay. I like to remind people that the 2 and 3% rates that we saw in 2020 and 2021, it was kind of a unicorn event. I really hope people don't expect that to happen unless another unicorn event happens, which I really hope nothing like that happens again or anything, right? Nobody wants that to happen.
No, exactly.
So don't ever expect 2 and 3% rates again. 4s, maybe it's kind of a gamble, but I think a realistic number is going to be 5s at some point. We're pretty close. We're in the 6s now.
That's great.
Right? We're only like a point off-ish. It depends on what day it is.
Yeah.
So the payment, you asked about the payment. So
do you think that's going to bring more people back into the market?
Of course.
Okay.
I've seen on average that payment savings is $300 to $600. Depends on the price range, right?
Right.
Yeah.
But
the house itself.
Major differences, right? That'll also put people from one community to the next, right? Because price points are different.
That's correct.
Yeah.
Yeah.
So they can get into their dream community or wherever right? So because affordability is more realistic now.
Mm-hmm.
The future of interest rates, we feel they will continue to come down little by little. Me personally, and I think a lot of the projections that people who are way better at predicting rates than I am, but 5s-ish is probably where the floor is going to be for the foreseeable future.
And historically, that's still...
Oh, my gosh. Yeah.
Great.
That's great.
It's like average. Yeah. Like 5s, even I think low 6s is like historically average back to I don't even know, the 70s, I want to say.
Yeah.
So the affordability's gotten better by the hundreds of dollars, right? It's helping to offset the prices that I know have gone up and the property taxes. So it makes it more affordable.
Yeah.
I really do. I was going to say, the interest rates, as they go down, people have the ability to refinance, right? And refinancing, for anybody who doesn't understand that, is you're redoing the terms of the loan to your benefit. And the most popular benefit is to lower the payment, and you do that by lowering the interest rate.
But then you go back in your amortization back
Correct.
to a 30-year or whatever. Yeah.
Yep.
But if somebody's been in for 5 years, they could redo a mortgage for 25 years.
Yes.
To keep that as well. So they have options.
Correct.
Yeah,
So there's
yeah.
different term options, right? So depending on your savings, Jeremy kind of mentioned, there's some potential negatives you have to be conscious of as you're restarting your term. But what's important to you is the conversation I have to have. Is it the monthly savings because money's tight and you just need every couple $100 you can? Or are you thinking of like long-term savings on the interest benefit? So you don't need the savings. So let's reduce the term 10 years because the payment's the same. And now you just shave 10 years off the mortgage, right? That's a biggie. If your goal is to never pay it off because my children are going to graduate high school in 4 years, so I'm going to sell in 4 to 5 years, well, then let's not think about payoff. Let's think about how do we save money in these next 4 to 5
Pay
years.
for the college.
Yeah, right.
They're doing
or
it.
whatever. Yeah, if it's money out, sometimes cash out, meaning you take out the equity that you've gained as a benefit and put it somewhere else, that like college or other investments sometimes.
Mm-hmm. Well, and that's changed that mindset for generations, because previous generations, including our parents and grandparents, their goal was to pay off the house, right? That's the number one goal.
Right.
And so I think that's really changed for a lot of people over the course of 20, 30 years.
I feel like the mindset is invest in more real estate lately.
Yeah.
I don't know if you see that from some people, but so they're taking equity out and they're buying the second homes and the investment properties.
That's interesting.
Yeah. Or they're moving up, right? Baby's on the way, or third baby's on the way, or we got 3 dogs now and we just need more room, whatever the reason. Work at home, that was a biggie, right? So as people start to work from home, they need an office or 2 offices, some more space. So we're using the equity to make I guess, do we call it an investment or not? I like to. You're using the equity and investing into another piece of real estate, right?
Yeah.
So,
Right. Let me ask you, Josh, a lot of the industry, much of the industry has changed, and we've gotten that lawsuit, which I'm sure you've been pervious to, where it's changed the commissions and how agents are getting paid. Give me an idea how the lending aspect can contribute to offsetting what that buyer may have to pay their buyer's agents. And are there different ways that, that lender can help? Are there any different ways or strategies that you would share with a buyer when you're meeting with them? Because these are the conversations now that we have to have up front with our buyers, which is really good. Again, adding the transparency. In the event that I don't get paid as a buyer's agent and I'm working with one of your buyers, that buyer is going to have to come to the closing with some money. Or could. Yeah, they could. And are those funds verified with the bank? Do they have that money? Or can we go back to that seller and say, let's do a closing cost contribution, and can we share that? So I don't know that information. What have you seen on the lending side?
Yeah.
And how can that contribute to the listeners, the buyers out there, and even the sellers, on the way that they strategize selling their house, or the buyers buying a house? Like, what can you share with them based on that information?
Yeah, I'll say quickly that just so people understand, I think what we're talking about, that the buyer in the past and still even today, usually their buyer's agent gets paid through the seller. In the event that doesn't happen, we need to know what to do. And as a lender, I'm now laying out 3 options. The first option is what normally happens is the buyer's agent is paid by the seller. So as a buyer, you don't have to worry about anything. What if it doesn't? So there's 2 more options left. The first one is, do we ask the seller for a credit to help offset the costs of the buyer's agent, which you can do. Now, there's rules to that. There's limits or caps, we call it. Now, when you ask for a credit, take a step back. You can ask a seller for a credit to pay for your lender closing costs and or to pay for prepaid items, which is the escrow account. I know we didn't talk about that. The escrow account, by the way, is the property taxes and homeowners insurance. So there's that bucket of credits, but we can also do another bucket of credits for the buyer agent's cost or commissions. Those are separate when it comes to the limits that's allowed. So let's say you capped out your lender costs and you ask for another credit for the buyer agents, that's allowed. Okay? That's something I don't think people knew. It actually was allowed many, many, many years ago. It just wasn't as relevant as it is today. Okay? So there's a lot of room in there if you can negotiate and ask the seller for that credit to help you. The third option is kind of like a hybrid. We look at how does the buyer pay for maybe some of it, and then you can also ask the seller for some of it. Lenders can reduce their costs to help the buyer. There is the cost for doing that, which is usually a higher interest rate.
Impacts their rate.
Right? The payment goes up. And then we get into what's more important to you. Is it the out-of-pocket cost or the payment?
Makes sense.
We have a lot of buyers. Like, for example, I'll see a lot of people that come right out of college and they don't have a lot of money saved, but they just took a nice, like in the medical industry, like we'll see physicians, right?
Yep.
They have engineers, anybody who has a great salary on a new job. They have a lot of income coming in, but they don't really have much saved. So the payment's well affordable for them. They just don't have a lot of out-of-pocket money. So that'd be a scenario where, right, we tilt those scales to what is beneficial for them. As a lender, we verify the money ahead of time to make sure that they have the worst case scenario, right? If they have to come out with more money to pay the buyer's agent. If they don't.
So you are verifying that now? Okay.
Yeah. And I have the conversation with you. Hey.
So if they're buying a $400,000 house, you have to verify, let's say in the state of Wisconsin, it's pretty typical 2.4% to the buyer's agent.
Correct.
Are you calculating that based on $400,000?
Correct.
2.4%.
Correct.
Verifying that they have close to $9,000.
Correct. And I'll let you know if they don't. So everybody's on the same page.
Absolutely.
We'll still pre-approve them.
No surprises.
Because most of the time we won't have to worry about that. But in the event we have a listing that we do, what do we do, buyer, right?
Yeah. It's so important.
You need to know that at offer time. Are we asking for credits? Or are you going to pay all that out of pocket? Because maybe mom and dad's going to gift you some money, or, we can have family gift money. There's so many things and solutions there potentially.
Yeah.
So.
I see it. I see it. I mean, it's actually, I thought it would stay pretty even keel with 2.4 being offered to buyer's agents on every one, but it's fluctuated on a lot of listings.
Yeah.
Some people are saying buyer or seller at this time is not offering any compensation. However, you can write it into the offer.
Yep.
They're not offering any suggested price per se, but it is, it is in the provision of the offer to purchase where you can write in what you would want. Yeah. So it's the conversations I'm having with buyers. I'm looking at some of these people that are first time home buyers, and they're a little scared. Especially with the information that I tell them about, like how we're going to look at a house and how we're going to break down the cost of the home and what's wrong with the house. And, this is what you're buying, but then also you may have to pay the buyer's agent my commission. They're like, oh, wow, this is a different way to buy a house. There's a lot of variables.
They thought.
Yeah.
Yeah. And that's the worst case scenario.
It is the worst case.
History tells us what? You guys probably have stats on it, but 90% of the time, that's not going to happen.
Stat man here.
Yeah. Maybe a good stat to look up. Yeah, but
stats are facts.
I think that's why it's and we talked about this on prior podcasts, and I think everything even that you're saying just reiterates that, is to have conversations, right? That I think it's important for customers, people who are looking to buy a house, whether it be the agents, how it's going to look, and what, and being able to be transparent and be able to communicate that. And the same thing when they talk to lenders, right? To go in and talk to a few and really, get the layout and make sure you're comfortable with what you're doing, because it is a big financial decision, right? And there's a lot of emotions that go into it. And I think in the past there was so many people that would just talk to one person and that would be it.
Correct.
Right? Because they didn't know. And they're like, maybe you should know this, so I don't want to push back on this. Right. I'm just going to take that as gospel, so to speak. And the reason of this podcast and social media, that's, I think, changing, where people are going to be more educated, being able to have more conversations and make sure that when they do this, that they're comfortable and they have all their questions answered and they're completely comfortable with it.
Yeah.
So
I want to bring up one thing you mentioned earlier about some people don't have enough money saved. So they put it on hold and they said, I'm going to wait a year or so and save more money so then I feel like I can afford a house.
yeah.
So on average, $10,000 is going to change the payment about $65. Okay. So the question I have to ask the buyer is the ones that want to kind of wait and say, I need to save more money. Okay. Because I need to know what payment is going to be affordable, because usually it has to do with payment. So if they need the payment to drop $300 or something like that, so they think the solution is to save more money, which I agree. I don't disagree with it.
Yeah.
Where I do maybe disagree is that means you have to save $30,000 for whatever the number is. How long is it going to take you to save $30,000? And that answer depends on the income, can be 5 years, 7 years.
Mm-hmm.
And this is where it's called the cost of waiting, right? And we talk about this a lot in the lender world is, what is it going to cost you if you wait another 5 years? Price points will be higher. How much equity you lost, how much rent, if you're renting, how much rent did you pay? There's a lot lost there, right? Then to try and make, because that's why these no down payment or small down payment options might make sense.
Yeah.
Because the equity is being built as you wait that out.
And save that money, put it in a bank, just have it, because things could come up with the house. Be more comfortable as you make this big purchase as well. So those are all great conversations that are being had. But I think just so much goes into it. I mean, you touch on so many different subjects.
We could be here for another hour.
Yeah,
correct.
Talking about financing, lending.
So we're going to have to, as things change, interest rates come down, we'll definitely have to have you back.
Yeah.
But, for everybody who's listening, I think, hopefully you're walking away with there's a lot of different options. There's a lot of things to consider, and just having good conversations, talking to people like Josh, and sit down and have those conversations and get comfortable, because it is a big financial decision. There's a lot that goes into it. Hopefully things that today that maybe you weren't aware of, because that's the reason why we're here. So with that, Josh, I want to thank you for coming in today.
Absolutely. Yeah.
And join us on our podcast. Jeremy and I, we appreciate you tuning in. And again, please share with friends, give us feedback, subscribe, and we look forward to seeing you on the next episode.
See you on the next episode.
Thanks. Have a great day.
Thank you. Thank you for tuning in to this episode of Location Community. I hope today's episode gave you a deeper understanding on how the right community can enhance your living experience and enrich your life. If you enjoyed today's episode, be sure to subscribe, leave us a message, and share it with your friends or anybody looking to make the most informed decision about where to live. And remember, it's not just about the house you buy, it's about the community you're joining. Until next time, I'm Jeremy Daring and Mike Rohr, reminding you that the best investment you can make is in a place where you feel connected, supported, and inspired. See you on the next episode.